The introduction explains the main idea of the book. Money decisions are not based on intelligence. They're based on behavior. Key points. People make financial choices based on their life experiences, not logic or education. Two people can look at the same situation and make completely different decisions. Both may be right in their own way. You can't teach someone how to behave with money through math or charts. It requires understanding human nature. Financial success comes from patience, humility, and emotional control, not just knowledge. Core message. How you think and feel about money is more important than what you know about money. By the way, you're watching Beyond the Cover, where we simplify life-changing books to help you grow smarter and richer every week. Hit subscribe if you're serious about growth. Chapter 1. No One's Crazy Detailed Summary. Main idea. Everyone makes financial decisions based on their own unique experiences, and those experiences vary widely from person to person. What seems foolish to one person may make perfect sense to another. Why no one's crazy? People aren't irrational. They're just working with different life stories. Personal financial behavior isn't driven solely by logic. It's shaped by emotion, upbringing, environment, and the time period in which someone grew up. Housel argues that to understand financial behavior, we must consider people's life contexts. Examples from the chapter. Stock market trust. Someone born in 1950s America likely saw stock market growth during their adult years. They may view investing as safe and profitable. In contrast, someone who experienced financial collapse or war may see investing as risky or even foolish. Inflation and scarcity. A person who lived through high inflation might avoid keeping cash and prefer physical assets like gold or real estate. Savings behavior. A child who grew up with very little money may grow into an adult who hoards cash or avoids spending, even when it's safe to do so. Someone raised in comfort may take on more financial risk, assuming stability will always be there. Key insight. People make financial decisions based on the world they know, not the world you know. That's why two smart, reasonable people can reach completely opposite conclusions about the same financial situation. Implications. Don't judge others' financial choices. They're shaped by experiences you haven't had. Be cautious with universal financial advice. What works for one person may be wrong for another. Reflect on your own money habits. They may be based more on fear, trauma, or comfort than logic. Quote from the chapter. People do some crazy things with money, but no one is crazy. Why this chapter matters. It encourages empathy when discussing money with others. It reframes financial behavior as a psychological pattern, not a math problem. It builds a foundation for the book's central theme. Behavior matters more than intelligence in financial success. Chapter 1 Key Takeaways. Lesson meaning. Everyone's story is different. Our background shapes how we view money, risk, and opportunity. No one-size-fits-all. Advice financial plans must reflect personal context. Behavior isn't always logical. It's shaped by deep emotional and environmental factors. Avoid judgment. What looks irrational may be someone's way of protecting themselves. Chapter 2. Luck and Risk Detailed Summary. Main idea. Financial success is often influenced by forces outside your control, luck and risk. These two elements play a bigger role in outcomes than most people are willing to admit. What this chapter teaches. Not all success is due to hard work, and not all failure is due to poor decisions. Luck is when things go better than expected due to chance. Risk is when things go worse than expected, also due to chance. People often underestimate how much chance affects outcomes, especially in investing and business. Key example, Bill Gates versus Ken Evans. Bill Gates went to one of the only high schools in the world with a computer at the time. This gave him an incredible head start. His friend Ken Evans, equally smart and driven, died in a mountaineering accident before reaching adulthood. The point, Gates' success involved talent, yes, but also luck. Evans' failure was simply bad luck. Important lessons. Be careful who you admire or criticize. People often attribute success to skill when much of it may be luck. People often blame failure on poor choices when it may be risk. Don't copy strategies blindly. What worked for someone else may not work for you because the circumstances may never repeat. Be cautious about learning the wrong lesson from someone else's story. Luck and risk are invisible forces. They're hard to measure but always present. We notice outcomes, but not all the variables behind them. Quote from the chapter: "Be careful who you praise and admire. Be careful who you look down upon and wish to avoid becoming." Everyone's outcomes are guided by forces other than individual effort. Why this chapter matters. It reminds us to be humble in success and empathetic in failure. It helps you avoid overconfidence and urges you to consider unknown factors. It encourages a long-term mindset. The role of luck may balance out over time, but can shape any single moment. Chapter 2 Key Takeaways. Lesson meaning. Success is not always earned. Luck plays a role in good outcomes. Failure is not always deserved. Risk can ruin even good decisions. Don't copy blindly. What worked for others may not work for you. Stay humble. Recognize that not everything is in your control. Show empathy. Other people's mistakes may just be misfortune, not stupidity. Chapter 3. Never enough. Detailed summary. Main idea: greed is dangerous. No matter how much money you have, if you always want more, you'll never feel satisfied and may risk everything in the process. What this chapter teaches: many people don't have a clear definition of enough. The constant desire for more money, more status, more power, can push people to take reckless risks even after they've already won. Financial success is not just about gaining. It's about knowing when to stop. Key story: Rajat Gupta versus Ronald Read. Rajat Gupta, former CEO, extremely wealthy and respected, but he wanted to be even richer, like billionaires he knew. He committed insider trading and was sent to prison, losing his reputation and career. Ronald Read, a gas station attendant and janitor who lived modestly, quietly saved and invested for decades, died with over $8 million in wealth and donated most of it. Lesson: Rajat had everything, but it wasn't enough. Ronald had modest means, but he understood contentment and ended up truly wealthy. Important messages: knowing when you have enough is a superpower. Most financial disasters come from the inability to say, "This is enough for me." Comparison leads to ruin. Someone will always have more than you. If you measure yourself against others, you'll never win. There's no point in risking what you have for what you don't need. The cost of chasing more can be your freedom, peace of mind, or everything you built. Quote from the chapter: "There is no reason to risk what you have and need for what you don't have and don't need." Why this chapter matters. It teaches self-awareness in financial planning. It warns against greed, envy, and the dangers of comparison. It encourages you to define what enough means for you so you can protect your wealth and peace of mind. Chapter 3 Key Takeaways. Lesson meaning. Know what's enough. Set a personal limit to avoid endless chasing. Don't compare constantly. Someone will always have more. Comparison is a trap. Greed is a threat to success. Wanting too much often leads to losing what you already have. Protect your peace, not just profits. Wealth is worthless if it costs your freedom or reputation. Chapter 4. Confounding Compounding. Detailed summary. Main idea: compounding is powerful, but it's hard to understand emotionally because its results take time and grow quietly. The biggest financial outcomes often come from small actions repeated over long periods. What this chapter teaches: compounding is the most powerful force in finance, yet people often overlook it because its results are not instant. Many people focus on big wins or brilliant strategies, but long-term patience and consistency often produce far greater outcomes. Time matters more than rate of return. Starting early and sticking with it is more valuable than trying to get higher returns quickly. Key example: Warren Buffett. Buffett is one of the richest people in the world, not just because he's a good investor, but because he started investing at age 10 and never stopped. He made over 90% of his wealth after age 50, thanks to decades of compounding. If Buffett had retired at 60, he wouldn't be nearly as rich. His greatness is due more to time than exceptional strategy. Important messages: small, consistent growth beats short bursts of brilliance. Most people want fast results, but real wealth often comes slowly. The full power of compounding is revealed only after many years. This is why people give up too soon or switch strategies too often. Patience is the most underrated financial skill. The key is not to earn the highest return, but to earn a decent return and let it compound for a long time. Quote from the chapter: "Good investing isn't necessarily about earning the highest returns. It's about earning pretty good returns that you can stick with for a long period of time." Why this chapter matters. It shifts your focus from quick wins to long-term thinking. It explains why time in the market is more important than timing the market. It encourages habits like early saving, consistent investing, and emotional discipline. Chapter 4 Key Takeaways. Lesson meaning. Compounding takes time. Real results show up after years, not months. Time, strategy starting early beats trying to be clever later. Patience builds wealth. Staying consistent is more powerful than chasing high returns. Buffett's secret is time as skill mattered, but his long time horizon mattered even more. Chapter 5. Getting wealthy versus staying wealthy. Detailed summary. Main idea: getting rich and staying rich are two completely different skills. Getting rich often requires risk-taking, confidence, and optimism. Staying rich requires humility, caution, and fear of losing what you have. What this chapter teaches. Different mindsets are needed for different stages of wealth. Many people know how to make money, but not how to keep it. Staying wealthy means avoiding unnecessary risks and not assuming past success guarantees future success. Survival is a foundation of long-term wealth. Housel argues that you only need to do a few things right and avoid losing it all to stay wealthy over time. Making smart decisions consistently over decades matters more than occasional big wins. Key traits to stay wealthy. Frugality. Don't increase your lifestyle too quickly. Humility. Understand that markets can change and you're not invincible. Paranoia. Always prepare for the possibility that things might go wrong. Flexibility. Keep enough margin and cash to handle unexpected events. Key example. Many once wealthy people lost everything because they overestimated their knowledge, took too much risk, or didn't prepare for downturns. Staying rich is about survival, not brilliance. Quote from the chapter. Getting money requires taking risks, being optimistic, and putting yourself out there. But keeping money requires the opposite: humility, and fear that what you've made can be taken away from you just as fast. Why this chapter matters. It teaches you to balance risk and caution. Don't assume you can handle more just because you've succeeded in the past. It reminds you to protect what you've built, not just chase more. It explains why preservation is the real key to financial independence. Chapter 5 Key Takeaways. Lesson meaning. Getting rich is about risk. Building wealth requires bold action and optimism. Staying rich is about survival. Protecting wealth requires caution, humility, and resilience. Avoid overconfidence. Past success can lead to risky behavior if you're not careful. Prepare for the unexpected. Having backup plans and margin helps you stay financially secure. Chapter 6. Tails, you win. Detailed summary. Main idea. A small number of events often account for the majority of success. In investing and in life, a few big wins, called tail events, can outweigh hundreds of small losses or average outcomes. What this chapter teaches. Tail events refer to rare, extreme outcomes that have an outsized impact. In business, investing, and innovation, a small number of successes generate the majority of returns. Most investments, ideas, or decisions don't work out, but the few that do can make up for everything else. Key concepts. Outcomes are not equally distributed. In most areas of life, the biggest returns come from a few rare events. In stock investing, a handful of stocks like Amazon or Apple have produced most of the gains in the market. Failure is normal. Success is rare but powerful. It's unrealistic to expect every idea, stock, or venture to work. What matters is staying in the game long enough to catch a few big winners. Investing is messy, but that's okay. Most professional investors have more losers than winners. The goal isn't perfection. It's being around when a tail event hits. Key example. Venture capital firms know most startups will fail, but they invest anyway because one or two big winners like Google or Facebook make up for all the losses and then some. The same applies to the S&P 500, where a small group of companies drive most of the index's returns over decades. Quote from the chapter. You can be wrong half the time and still make a fortune because a small minority of outcomes often account for the majority of results. Why this chapter matters. It encourages patience and persistence. It helps you understand that losses, mistakes, and underperformance are part of the process. It teaches you not to quit just because some things didn't work. You only need a few big wins. Chapter 6 Key Takeaways. Lesson meaning. Big wins matter more than averages. A few extraordinary outcomes drive most of the success. Losses are part of the journey. Many investments or ideas will fail, and that's normal. Don't aim for perfection. Aim to stay in the game long enough to catch tail events. Focus on long-term exposure. Be consistent, so you're around when rare success strikes. Chapter 7. Freedom. Detailed summary. Main idea. True wealth is the ability to control your time. More than luxury or riches, the greatest financial reward is having freedom over how you spend your day. To do what you want, when you want, with whom you want. What this chapter teaches. Control over your time is the most valuable form of wealth. Money is only meaningful if it buys you something valuable, and nothing is more valuable than autonomy. People often chase money for status or material things, but time freedom brings deeper, long-lasting happiness. Key concepts. Money's highest dividend is control. The real benefit of money isn't cars or vacations. It's being able to say no when you want to. Freedom gives you the ability to make decisions that reflect your values and priorities. The illusion of more money equals more happiness is flawed. Studies show income increases happiness only up to a point, basic comfort. After that, gains in well-being come more from freedom and autonomy, not more income or material goods. People underestimate the value of time control. Many people trade time for money without realizing they're losing the most important asset they have, their freedom. Those who feel in control of their schedule consistently report higher satisfaction in life. Real-life example. A wealthy person working 80 hours a week with no time for family or self-care is not truly rich. A middle-income person who works on their own terms, has flexibility, and time for what matters is wealthier in a real sense. Quote from the chapter. Controlling your time is the highest dividend money pays. Why this chapter matters. It shifts the focus of financial success from riches to freedom. It helps you rethink your goals. Are you chasing money or are you building a life you control? It reminds you to value time as much or more than income. Chapter 7 Key Takeaways. Lesson meaning. Wealth equals control over your time. True richness is having freedom in how you live your life. Money should serve your lifestyle. Use money to gain autonomy, not to impress others. Happiness comes from autonomy. Feeling in charge of your time increases life satisfaction. Reframe financial goals. Don't just aim for more money. Aim for more freedom. Chapter 8. The Man in the Car Paradox. Detailed summary. Main idea. When you try to impress others with money or status, it rarely works the way you think. People admire the possessions, but not the person. True respect and admiration come from how you treat others, not from what you own. What this chapter teaches. Most people spend money on expensive things, cars, clothes, homes, to gain respect or admiration. But in reality, others don't think, wow, that person must be amazing. Instead, they think, I'd look cool in that car. This is a man in the car paradox. People focus on the item, not the owner. Key concepts. Status symbols rarely earn the respect you think. When someone sees you in a luxury car, they don't admire you. They imagine themselves driving it. We overestimate how much others care about our success or appearance. Buying things to impress is often driven by insecurity. Many people spend to prove something, often a lack of self-worth or fear of being ignored. But authentic respect comes from behavior, not wealth. The pursuit of admiration is often misdirected. People want to be liked and respected, but trying by admiration usually fails. Humility, kindness, and generosity generate far more admiration than expensive things. Real-life observation. The person driving a Ferrari might believe others envy them, but observers aren't thinking about the driver. They're picturing themselves in that car. So, the driver doesn't actually gain admiration. Only the object does. Quote from the chapter. People tend to want wealth to signal to others that they should be liked and admired. But in reality, those other people often bypass admiring you. not because they don't think wealth is admirable, but because they use your wealth as a benchmark for their own desire to be admired. Why this chapter matters. It helps you realize that chasing status through spending is a hollow game. It encourages you to shift your focus inward. Live a life you respect rather than chasing validation from others. It frees you from a pressure to prove yourself through money. Chapter 8 Key Takeaways. Lesson meaning. People admire things. Not owners' flashy purchases rarely earn personal respect. Status seeking is often ineffective. True admiration comes from values, not wealth. You can't buy respect. Money may buy attention, but not lasting admiration. Be humble, and authentic, genuine humility often leads to deeper social respect. Chapter 9. Wealth is what you don't see. Detailed summary. Main idea. True wealth is invisible. People often confuse wealth with luxury spending, but real wealth is the money you don't spend. It's savings, investments, and financial freedom, not the expensive stuff that others can see. What this chapter teaches. Spending is not a sign of wealth. Expensive cars, watches, or houses often belong to people who have spent their money, not saved it. In contrast, wealthy people often live modestly, because wealth is about having assets, not showing them off. We often admire visible success, but overlook invisible discipline. Saving money, avoiding debt, and investing wisely aren't visible to others, but they're the real drivers of financial freedom. Consumerism can mask the truth. Many people look rich but are deeply in debt or living paycheck to paycheck. Key concepts. Spending reduces wealth. Every dollar spent is a dollar that can be invested or saved. Flashy purchases may increase social status but decrease financial security. Wealth is quiet. The people who achieve financial independence often don't look rich. What you don't see, the restraint, the budgeting, the delayed gratification, is what builds wealth. Rich versus wealthy. Rich is how much you spend or show. Wealthy is how much you keep, save, and grow. Real life example. A person who drives a $100,000 car may no longer have that $100,000. It's gone. A truly wealthy person might drive a used car, but have millions invested quietly in stocks or assets. One is showing success. The other is building freedom. Quote from the chapter. Wealth is financial assets that haven't yet been converted into the stuff you see. Why this chapter matters. It changes how you judge success, not by appearance, but by discipline. It frees you from the trap of keeping up with others by showing that real wealth is internal, not visible. It helps you focus on saving and long-term thinking rather than showing off. Chapter 9 Key Takeaways. Lesson meaning. Wealth is what you don't see. True financial strength is often invisible. Spending is not proof of success. Big purchases show consumption, not savings. Saving is underrated. Building wealth requires keeping more than you spend. Focus on freedom, not image. Financial independence matters more than social approval. Chapter 10. Save money. Detailed summary. Main idea. You don't need a high income to build wealth. You need to save money consistently. Saving is a foundation of financial independence and flexibility, and it's often more powerful than investment returns. What this chapter teaches. Saving money is more about behavior than income. Even people with modest incomes can build wealth through discipline and consistent saving. Meanwhile, many high earners stay broke because they spend everything they make. Saving provides options and control. Savings equals freedom. It gives you flexibility during hard times. Freedom to make career choices or to take risks without fear. Key concepts. Building wealth doesn't require a big salary. Your saving rate, how much you keep versus spend, matters more than how much you earn. High income is useless without self-control and planning. Saving is simple, but not easy. It requires saying no to short-term pleasures for long-term security. It's about living below your means, even when you don't have to. You don't need a reason to save. Housel argues that having no specific goal for saving is okay, because the future is uncertain. Savings give you a buffer for anything life throws at you. Job loss, emergencies, or unexpected opportunities. Quote from the chapter. The only factor you can control generates one of the only things that matters. How wonderful. This refers to saving, the one part of your financial life that's fully under your control, and yet it creates the greatest security. Why this chapter matters. It redefines saving as a form of empowerment, not sacrifice. It shows that financial peace comes more from habits than income. It teaches you to value control over lifestyle inflation. Chapter 10 Key Takeaways. Lesson meaning. Saving is more important than income. Wealth is built by keeping, not just earning. Save without a reason. Flexibility and peace of mind are reason enough. Control is the real reward. Saving gives you power over your future choices. Spend less than you earn. The timeless principle of wealth building. Chapter 11. Reasonable, rational, detailed summary. Main idea. When it comes to money, you don't need to be perfectly logical. You just need to be reasonable. Financial decisions are not made in a spreadsheet. They're made in real life, with emotion, uncertainty, and personal values. What this chapter teaches. Pure rationality isn't realistic in personal finance. People make decisions based on things like comfort, fear, goals, and past experiences, not just numbers. It's okay to prioritize what works for you, even if it's not what a mathematical model suggests. Key concepts. Being reasonable is more sustainable than being perfectly rational. For example, paying off a low-interest mortgage early may not be rational. You could earn more investing that money, but it can be emotionally freeing. If a financial choice helps you sleep better or stay on track, it may be better than one that's optimal but stressful. Personal finance is personal. Your choices should align with your values, lifestyle, and risk tolerance, not just what experts or theories suggest. Avoid perfectionism. You don't need to make the perfect decision. You need to make one you'll stick with for decades. Long-term consistency matters more than short-term optimization. Examples. Investing in index funds is not the highest possible return strategy, but it's reasonable, simple, and effective. Some people pay off debt early, even when interest rates are low, because it gives them emotional relief. Others avoid the stock market because of fear, even if it's not rational, understanding that fear is still valid. Quote from the chapter. Do not aim to be coldly rational when making financial decisions. Aim to just be pretty reasonable. Why this chapter matters. It takes the pressure off of being perfect with money. It encourages financial self-awareness to make decisions that align with your own life. It shows that behavior, not math, drives real financial success. Chapter 11 Key Takeaways. Lesson meaning. Reasonable decisions last longer. It's better to stick with a good plan than abandon a perfect one. Emotions matter in money. Your comfort, fear, and values influence financial behavior. Personal, theoretical. Make choices that align with your life, not just what's optimal on paper. Consistency beats brilliance. Long-term behavior is more important than short-term genius. Chapter 12. Surprise. Detailed summary. Main idea. The biggest financial events are always surprises. Most of what shapes the economy, markets, and personal finances is unpredictable. Yet we often build our plans as if the future will behave like the past. What this chapter teaches. The most important events in history, financial or otherwise, are rare and unexpected. Predicting the future based on the past is tempting, but the future almost always brings surprises. Good financial planning means acknowledging uncertainty and preparing for the unknown. Key concepts. History is dominated by tail events. Like in Chapter 6, rare, impactful events shape the world. Wars, market crashes, pandemics, technological breakthroughs. These events are almost always surprises and not predictable from past data. We over-rely on historical averages. People assume markets will return X% every year or that recessions follow a pattern. But most years don't look average. Big gains or losses often happen in just a few days or months. Be cautious of overly confident predictions. Experts often fail to foresee the big shifts because the world is complex and full of unknowns. The most dangerous financial assumption is thinking you know what's coming next. Examples. The 2008 financial crisis, COVID-19, 9/11, all had massive financial consequences, but were largely unexpected. The invention of the internet and smartphones reshaped entire industries, yet few saw it coming in time to act. Quote from the chapter. The correct lesson to learn from surprises is that the world is surprising. Why this chapter matters. It builds a case for financial humility. accepting that we can't predict or control the future. It emphasizes flexibility over precision. The best plan is one that can survive surprises, not one that bets on perfect predictions. It teaches you to expect the unexpected and prepare for resilience, not just returns. Chapter 12 Key Takeaways. Lesson Meaning. Surprises shape history rare. Unexpected events drive most major outcomes. Don't rely on averages alone. Normal years are uncommon in finance and life. Stay humble about the future, acknowledge what you don't know, and plan accordingly. Flexibility is power. Prepare your finances to absorb shocks, not just optimize returns. Chapter 13, Room for Error, Detailed Summary. Main idea. The most important part of every plan is planning for things not going according to plan. In finance and in life, you must always leave room for error because uncertainty and surprises are unavoidable. What this chapter teaches. No matter how smart or well-informed you are, you can be wrong. Therefore, always build a margin of safety into your decisions. Extra savings, conservative forecasts, lower debt, etc. Room for error allows you to survive bad luck, adapt when things go wrong, and keep moving forward. Key concepts. Survival maximization. Financial success doesn't come from making the best decisions all the time. It comes from avoiding ruin. People who always aim for the highest return may take on risks that eventually destroy them. Predicting the future is hard and often wrong. You might assume your investments will grow at 8% annually, but what if they only grow at 4%? Building in room for error helps you stay safe even if things don't go as planned. Conservative assumptions equals long-term survival. Assume expenses will be higher than expected. Assume investments will sometimes perform poorly. Keep an emergency fund. Invest with humility and never bet the farm. Real-life examples. Engineers build bridges that can carry much more weight than expected. Why? Because safety margins save lives. Investors should treat their finances the same way. Leave slack in your plan so you're not wiped out by one bad event. Quote from the chapter. You have to plan on your plan, not going according to plan. Why this chapter matters. It reframes caution as strength, not weakness. It shows that being slightly conservative with money is not boring. It's wise. It encourages resilience over risk and long-term survival over short-term performance. Chapter 13 Key Takeaways. Lesson Meaning. Leave room for error. Build slack into your finances to absorb shocks. Survival is the ultimate goal. Better to stay in the game than win big and lose everything. Be humble with forecasts. Don't assume the future will go exactly as you hope. Prepare for bad luck. Plan for the downside, even if it seems unlikely. Chapter 14. You'll change. Detailed summary. Main idea. You will change more than you think. Your goals, values, and desires evolve over time. So it's dangerous to assume that what you want now is what you'll want in the future. What this chapter teaches. People often make long-term financial decisions based on who they are today, but your future self might want very different things. So be cautious about locking yourself into rigid plans. Financial flexibility is more valuable than fixed predictions. Key concepts. The end of history illusion. Psychologists have shown that people realize they've changed a lot in the past, but assume they won't change much in future. This illusion leads to overconfidence in long-term decisions like career choices, investments, or retirement plans. Avoid irreversible commitments. Don't tie up your future in decisions that are expensive or impossible to undo. Example, taking on huge debt for a house or lifestyle you might not even want in 10 years. Flexibility is key. Since your future is unpredictable, including who you will be, build financial plans that can adapt as your goals change. Examples, someone might spend heavily in their 30s for status, but later realize they prefer simplicity and freedom. A person might start saving aggressively to retire early, but later find purpose in work and want to keep going. Values shift over time. Comfort, adventure, legacy, security, family, all of these may become more or less important. Quote from the chapter. The trick is to accept the reality of change and move on as soon as possible. Why this chapter matters. It encourages humility about your own future desires. It helps you avoid regret by building plans that offer options, not restrictions. It teaches that the ability to pivot may be more valuable than precision. Chapter 14 Key Takeaways. Lesson meaning. You will change what you want today may not reflect who you'll become. Don't overcommit. Avoid decisions that limit future flexibility. Plan for change. Build a life and portfolio that allows you to adapt. Flexibility beats rigid perfection. Being able to adjust beats being right once. Chapter 15. Nothing's free. Detailed summary. Main idea. Everything has a price, even if you don't see it. In investing in personal finance, returns aren't free. The cost might not be obvious like a price tag, but it exists, often in the form of volatility, uncertainty, or emotional stress. What this chapter teaches. Every financial gain has a hidden cost. To earn higher returns, you must endure market volatility, fear, doubt, and patience. The mistake most people make is trying to get the reward without paying the price. Volatility is not a fine, it's a fee. Market ups and downs aren't penalties for doing something wrong. They're the price of admission to long-term wealth. People often panic during downturns because they didn't expect this emotional cost. Key concepts. Understand the real cost of success. Investing in stocks? The cost is tolerating drops and crashes. Starting a business? The cost is uncertainty, long hours, and risk. Building wealth? The cost is patience, restraint, and delayed gratification. Confusing volatility for a mistake causes panic. When people experience losses, they think something went wrong, so they exit early. But volatility is normal. It's a fee, not a fine. If you're not willing to pay the fee, you miss the reward. Be mentally prepared to pay. The key to long-term success isn't avoiding pain. It's knowing what pain is normal and being ready to deal with it. Examples. The stock market drops 30% and people sell in panic because they didn't accept volatility as part of the deal. Someone wants big gains but without risk, so they fall for scams or overtrade. Another person stays invested through market cycles, accepting the emotional cost, and ends up wealthy. Quote from the chapter. Like everything else worthwhile, successful investing demands a price, but its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regret. Why this chapter matters. It reframes volatility and emotional discomfort as normal and necessary. It prepares you to accept financial pain as a real cost of growth, not as something to run from. It protects you from making impulsive decisions when things get hard. Chapter 15 Key Takeaways. Lesson meaning. Everything has a price. Financial gains come with emotional and psychological costs. Volatility is a cost. Returns, don't fear it. Accept it as part of the process. Pay the fee. Don't run from it. If you want rewards, you must be willing to endure short-term pain. Be emotionally prepared. Success comes from knowing and accepting what you're signing up for. Chapter 16, You and Me, detailed summary. Main idea, people have different goals, time horizons, and priorities, so they behave differently with money. What works for one person may not work for another, and much financial conflict happens when people fail to see those differences. What this chapter teaches. We often judge others' financial choices without understanding their context. News, trends, and opinions are shaped by people with different goals than yours. The key to making good decisions is focusing on your own needs, not what others are doing. Key concepts. Time horizon matters. A trader holding a stock for a day and a retiree holding for 20 years will make completely different decisions. And that's okay. Yet people often follow advice or trends that don't match their situation. Financial strategies are not one size fits all. Some people want fast gains. Others want long-term security. Your neighbor might be speculating in crypto while you're investing for your kids' college. That doesn't mean either is wrong. Understand incentives and perspectives. Financial media often promotes urgency or hype, but they're not accountable for your losses. Always ask, does this advice fit my goals? Examples. A young investor might ride out high volatility for higher returns, while a retiree needs stability and income. One person might buy real estate for long-term income. Another might flip houses for fast profit. Same asset, different approach. Following the crowd can lead to poor decisions if the crowd is playing a different game than you. Quote from the chapter. Beware taking financial cues from people playing a different game than you are. Why this chapter matters. It encourages self-awareness in financial decisions. It helps reduce judgment and noise from others' choices. It reminds you to build a financial plan based on your values, goals, and time frame, not someone else's. Chapter 16 Key Takeaways. Lesson meaning. Everyone plays a different game. What works for others might not work for you. Don't follow the crowd, blindly understand your own goals before copying others. Customize your strategy-based decisions on personal timelines, needs, and risk tolerance. Filter advice through your context. Ask, does this apply to me? Chapter 17, The Seduction of Pessimism, Detailed Summary. Main idea, pessimism sounds smart. Optimism sounds naive. But over time, optimism wins. People are naturally drawn to negative news and warnings, even though progress is more common in the long run. What this chapter teaches. Pessimism grabs attention more easily than optimism. In finance, pessimistic predictions sound serious and intellectual, while optimistic ones sound unrealistic. But long-term progress in economies, markets, and humanity is more common than decline. Key concepts. Bad news feels more urgent. Our brains are wired to detect threats, so we respond faster to negative headlines. This makes pessimistic forecasts, market crashes, economic collapse more persuasive. Even if they're often wrong, growth happens slowly, decline feels sudden. Progress takes time and is often invisible. Downturns happen quickly and painfully, so we notice and remember declines more than growth, even though growth dominates over time. Fear sells. Media, influencers, and even financial experts often focus on what might go wrong, because fear gets clicks and attention, but basing your decisions on fear can cause missed opportunities and bad timing. Examples. The stock market has consistently grown over decades, yet many people stay out of it due to scary short-term forecasts. Doomsday predictions often don't come true, but they leave a lasting impression that keeps people from investing or taking risks. Optimists in the long run build businesses, invest in the future, and create wealth because they believe things can improve. Quote from the chapter, pessimism isn't just more common than optimism. It also sounds smarter. Why this chapter matters. It helps you build a more realistic, long-term mindset. It reminds you that while downturns happen, progress is a default in human history. It encourages optimism, not blind faith, but a rational belief that things generally get better over time. Chapter 17 Key Takeaways. Lesson meaning. Pessimism is seductive. It grabs attention and feels logical, but isn't always correct. Progress is slow and quiet. We often overlook long-term gains because they're less dramatic. Stay rationally optimistic. Believe in improvement, even when short-term news looks bad. Avoid fear-based decisions. Fear feels smart, but often leads to missed opportunities. Chapter 18. When you'll believe anything, detailed summary. Main idea. People believe false or overly confident financial stories because we crave simple explanations for complex realities. When we don't fully understand how something works, especially in money, we fill in the gaps with narratives, even if they're wrong. What this chapter teaches. Humans are story-driven, not data-driven. We often believe things about money, markets, or success because they feel right, even if they aren't logically accurate. This can lead to bad decisions based on myths, conspiracy theories, or misleading patterns. Key concepts. The power of storytelling. People don't make financial decisions based on statistics. They do it based on stories they tell themselves and others. Example. If you work hard, you'll be rich. Sounds nice, but isn't always true. The complexity of money invites false clarity. Financial systems are complicated and unpredictable, so people are drawn to simple, confident-sounding explanations, even if they're incomplete or wrong. Emotions fill in the gaps. Fear, envy, greed, and hope often influence beliefs more than facts. That's why people buy into bubbles, ignore risks, or fall for scams. They believe what they want to be true. Examples. 2008 financial crisis. People believe housing prices would always rise because that story was easier to believe than the truth about credit risk. Investment fads and bubbles. Investors buy in because of hype and a convincing story, not because of fundamentals. People believe lottery winners are lucky, ignoring how unlikely that outcome is. Quote from the chapter, the more you want something to be true, the more likely you are to believe a story that overestimates the odds of it being true. Why this chapter matters. It teaches self-awareness, knowing when you're believing something just because it sounds good. It warns against oversimplifying finance or blindly trusting confident advice. It encourages critical thinking and skepticism, especially when it comes to financial advice, media narratives, and trends. Chapter 18 Key Takeaways. Lesson meaning. Stories drive financial behavior. We follow narratives, not always logic. Simplicity is seductive. We crave easy answers to complex questions. Emotion often replaces evidence. Feelings like fear and greed distort what we believe. Be skeptical of confident claims. Just because a story feels right doesn't mean it is. Chapter 19. All together now, detailed summary. Main idea. This chapter is a recap and integration of all the core principles discussed throughout the book. Morgan Housel brings together the key ideas to show how they interact in real life and offers a practical foundation for building smart, durable financial habits. What this chapter teaches. Financial success is less about knowledge and more about behavior. There's no universal formula. What matters is consistency, humility, flexibility, and emotional control. The author shares his own financial philosophy based on the lessons covered in the previous chapters. Key concepts recapped. Save consistently. Wealth building begins with a strong saving habit, not income, luck, or high returns. Be reasonable, not rational. You don't have to be perfect. You just need a plan you can stick to long term. Do what works for you, even if it's not optimal on paper. Expect things to go wrong. Leave room for error. Prepare for surprises and volatility. Survival is more important than high performance. Avoid extremes. Don't take maximum risk or be overly conservative. Stay in the middle. Aim for a balanced, calm approach that lets you sleep at night. Respect the role of luck. Be humble. Understand that success often includes chance, and so does failure. Stick to your plan, but adjust when needed. Flexibility is strength. Life changes, and your financial strategy should too. Morgan Housel's personal financial strategy. In this chapter, the author shares his actual money habits. Saves a high percentage of income. Lives well below his means. Doesn't track the market daily. Invests mostly in index funds. Prioritizes independence and time over luxury. He does this not because it's mathematically perfect, but because it gives him peace of mind and long-term security. Quote from the chapter. Aiming to be mostly reasonable works better than trying to be coldly rational. Why this chapter matters. It reinforces the behavioral side of personal finance. It provides a complete, grounded philosophy anyone can follow, regardless of income level or expertise. It encourages you to design a financial life that supports your values, not just your bank account. Chapter 19 Key Takeaways. Principal meaning. Save aggressively. Saving is more powerful than chasing high returns. Be emotionally consistent. Stick with strategies you can maintain over the long run. Don't see perfection. Aim for what works for you, emotionally and practically. Stay flexible. Adapt as your life, goals, and values change. Focus on independence. Money should give you control over your time, choices, and future. Chapter 20, Confessions, detailed summary. Main idea. In this final chapter, Morgan Housel shares his personal financial beliefs and habits, explaining that they are not prescriptions, but reflections of his personality, values, and life experiences. The goal? To show that there is no single right way to manage money, only what's right for you. What this chapter teaches. Everyone's financial decisions are personal. What works for Housel may not work for others, and that's perfectly okay. Your financial strategy should align with your goals, fears, temperament, and lifestyle. Housel's financial philosophy, Confessions. He saves a lot, not for anything specific. Housel saves more than 20% of his income, not to buy something big, but to gain freedom and control over his time. He doesn't budget. Instead of tracking expenses line by line, he simply lives far below his means. This keeps money simple. He uses no debt aside from a mortgage. He chooses peace of mind over leverage, even if it means slower financial growth. He avoids chasing the highest returns. Most of his investments are in index funds. He doesn't try to beat the market. His goal is not to be rich fast, but to stay wealthy and stress-free. He prioritizes independence, having time, flexibility, and the ability to say no to things he doesn't want to do is his definition of success. He values simplicity. Complexity isn't worth it if it causes anxiety or confusion. He keeps his finances low drama. Key takeaways. Money is emotional. A good financial strategy has to match your personality, not just your goals. Wealth is what you don't see. He avoids flashy spending in favor of long-term freedom. Being able to sleep at night is a worthy financial goal. Quote from the chapter, "Every financial decision a person makes sense to them in that moment." Final thoughts from the author. Morgan Housel encourages you to reflect on what money means to you personally. Don't copy others blindly. Understand your own motives, fears, and aspirations, and build your financial life around those things. Chapter 20 Summary Table. Belief/value Housel practice. Simplicity over complexity avoids budgeting. Uses index funds. Peace of mind over performance doesn't chase the highest returns. Independent above, all saves a lot, avoids debt, values control of his time. Money should reduce stress, keeps finances emotionally sustainable. No one-size-fits-all. Advice believes personal finance should be personal. Final message of the book. Money is not about spreadsheets, forecasts, or formulas. It's about behavior, self-awareness, and aligning your financial decisions with who you are and what you value.